Hi, everybody. When the market's not ready to crack, it's not ready to crack. And I tell you what, today's intraday reversal, we just can't ignore it. The NASDAQ bounced off its 200-day moving average today on volume well above average. The intraday reversal in stocks like Facebook, YY, Twitter, King, UBNT, and various other stocks out there just give me the hint that, the market might either be A, trying to bottom, or B, it's going to bounce. We're short-term oversold, so we need to expect a bounce here. With that being the case, it's prudent to go ahead and take off 25% of our SRTY and SQQQ position. Look at that volume in the SQQQQ, and look at TQQQQ. Just can't fight that. And then also SPXU, going to take 50% off now that we're below the 50-day moving average. And FAZ, I don't even need it to be back below the 50-day moving average. We need to go ahead and take half of that off. We can continue to see how stocks act here. We further break down. We can easily add back some position. But for right now, I want to go ahead and reduce our short hedge just because the bounce today and the intraday reversal, it was the biggest intraday reversal in the NASDAQ in 5 years, I do believe, and it was just right off the 200-day moving average. And the Russell 2000 broke through the 200-day moving average and came back above it. So if this market was weak, the Russell would have closed below it, and the NASDAQ would not have bounced off of it like it did. So I can't fight that. But besides the sell signal, major concerns remain. I mean, this is what's hot right now. McDonald's, Taiwan Semiconductor, oil stocks. I got oil stocks all over the place. Johnson & Johnson, Coca-Cola. I got Coca-Cola looking good. Got CXO, got PXD looking good. So overall, you can tell just by the quality that we have out here, we're not dealing with a market that's rewarding investors in high growth names. We're rewarding a market in safety. So this is a safety move, and I will remind you all, the S&P 500 did hit new highs in the second half of the year 2000 before we did roll over and eventually start a real bear market. So I want to show you all this. The year 2000, that hard right edge. Look at the NASDAQ and then look at the S&P 500. I know it's a little different right now, but as you can see, post the March highs in the S&P 500, we hit new highs, while the NASDAQ back here in March did not. But if you look at the S&P 500, once again, back in March, after the highs in early 2000, we hit new highs. So it's a market that we need to go ahead and recognize what we're dealing with. I actually did manage to get two full sells. The VSB has failed the 50-day moving average, low volume or not enough that I'm out of that one completely. And PRIS, I'm done. I'm not going to wait for it close below 210 to get rid of all of it. To me, it looks like it's rolling over. This stock, the sector should have gone higher. I don't know. It's not, but it's not. Whatever. I don't argue. So with all that action, I also want to look at the biotech stocks. You can see the biotech stocks reverse on heavy volume over the 3 days. It's pretty big volume. It looks like it's way, way, way oversold. So, I mean, come on. We got to expect a bounce here. We've gone from over, on this index alone, we've gone from, about 110 down to, we hit 60 intraday. So we had we had about a 45% pullback in a short period of time. We're going to bounce here. If we roll over on this index, I'm sure it'll stretch out to other sectors. But for now, oversold, and we got to go with the market. I mean, the move in Twitter and King, it's just too much. It's just too much. And AKBA in the IPO land, I just have enough information out there that I want to step more to the sides. Still keeping the hardcore short position on, because we're nowhere near those old highs in the NASDAQ. The S&P 500 is still littered with distribution. And let's not forget about the VIX. Mr. Complacent VIX chilling out here at the 15 level. Despite prices in the market and the growth stocks, being decimated, the NASDAQ and Russell 2000 looking weak, the VIX has just remained tame this entire time. Combine that with Investors Intelligence at 1987 pre-crash levels and New York Stock Exchange margin debt at record levels, and I find it very hard to think that we're going to correct the damage that we've done quickly overnight. But the reversal so far today with the volume indicate we might. We could easily bounce back to the old highs and then really fail. If that's the case, it's going to be better short positions. But for now, I'm not going to fight the tape. And on that note, PSA, this retail investment trust stock, clear pocket pivot point signal. While real estate investment trusts aren't necessarily looking the greatest, the comeback today reverses the damage that happened to them on the 10th. Great comeback. OFC is still holding in. There were many stocks that decided to move higher today in that area. SLG is just one of them off the top of my head. So PSA, since it's not a risky stock and because we are short this market, in case we do want to move higher, especially with these New York Stock Exchange defensive stocks, PSA is going to be 5% of my account capital in this stock. If we're wrong, we're not going to risk a whole lot. If we're right, we're not going to gain a ton. So 5% of my account capital appears appropriate here. XEC, energy stock, high price stock. Once again, 5% of my account capital will be added to the stock. Excellent pocket pivot point signal and very strong volume. Sadly, the MACD line below isn't that bullish. But TSV is good. BOP and relative strength is good. Price volume is good. So XEC 5% add, PSA 5% add, reducing 25% of SRTY, SOXS, and SQQQ, reducing half of SPXU, reducing half of FAZ. We're going to see what happens, but stocks like Goldman Sachs, Bank of America, JP Morgan, they don't look out of the woods yet, but they don't look terrible yet. So sure, we're going to be choppy. But to mitigate that, we'll put on 10% of our long positions in XEC PSA, just in case the market moves higher. Even if the market moves lower, these stocks on a real strength basis are strong. So even if the market remains choppy here, these might do well with energy stocks and utilities and REITs clearly leading the way.